Real estate investment trusts, or better known as REITs, are an important segment of Singapore's capital markets, both in equities and in the credit markets. With the increase in interest rates and negative headlines over commercial properties and related property funds in certain geographies, one of the questions that we've been getting is whether or not we should be worried about Singapore-listed REITs. In terms of credit implication, we have observed interest coverage ratios becoming thinner, and this is mainly from the higher cost of funding with interest rates increasing. That said, REITs have been increasing their percentage of fixed-rate debt and also taking on more hedges. Based on debt maturity profiles, there's little to suggest that REITs we cover will face difficulties in accessing financing this year, although there will be more debt coming due next year. Overall, while we think that credit metrics will deteriorate for the sector, bulk of the REITs we cover are able to keep within their current credit profiles, barring maybe one or two. However, financing and capital structure aside, another important consideration is the income driver for each REIT. This is very much affected by specific properties each REIT holds. For example, what are these properties? Office versus industrial versus hotels have different income drivers, where the properties are located, and the rental terms for the property. A handful of REITs listed in Singapore have been in the headlines due to a drop in asset valuation on the back of a soft operating environment and negative impact to exchange rates. What we are seeing is a demarcation in the Singapore REIT universe, where some REITs are continuing to perform strongly and have started to expand by buying new properties as well as spending capital on property redevelopment, while some REITs are grappling with a changing demand situation. For example, in cities with long commuting times, where work-from-home transition is causing a negative impact to property usage. Away from Singapore REITs, there have been cases where property fund managers have chosen to hand back their keys to creditors, or in other words, defaulted on their debt obligation. We see this as specific cases, typically driven by properties where they were bought when interest rates were low and prices of the properties were high, with owners now facing headwinds of higher interest rates as well as a weakening tenant demand outlook. There is little reason for owners to need to default if the underlying properties still provide positive yield above cost of funding and where the use of debt has been disciplined, as in the case for the bulk of the REITs under our coverage. Adding to investor concerns, certain property funds are facing high redemption from investors. Effectively, these investors want their money back, and high-profile asset managers have needed to restrict redemptions. While Singapore REITs are a type of property fund, we do not view them to be in the same bucket as these funds that are restricting redemptions. These unlisted funds allowed investors to redeem at regular intervals, even though property is an illiquid asset class. It is perhaps the illusion of liquidity that made this type of funds highly popular with investors, and that the redemptions could not be fulfilled at a time of property market dislocation. The asset managers would have needed to quickly sell property assets into an unfavorable market to fund redemptions. Singapore REITs are mainly listed and tend to have a liquid secondary market. This means that investors can reflect their expectations on the future of the REIT through the price of the REIT. For an investor in the Singapore REIT who wants to cash out, the investor can sell their REIT units to other investors who may have a longer-term investment horizon or a different investment view, especially if the price is right. We saw REIT unit prices taking a dive in 2022, and prices were also volatile in the past 6 months. But that said, as the market starts considering that we are nearer to the peak of this rate hike cycle, we expect Singapore REITs to regain strength and will continue to advocate REIT by REIT selection, given that each REIT has different income drivers.